Yeah, a key inflation report, though, is on deck for next week. So February CPI due out on Wednesday. Economists expecting a 2.9% rise in prices year on year, according to FactSet. That would mark a slight deceleration from January. For more on the macro environment, Apollo's chief economist, Torsten Slok, joins us here on set. Torsten, welcome to you. Great to have you here on set. What do you make of the jobs report? How does that set up the CPI report for next week?
Well, I do think that the soft data going into today's number has been deteriorating, both when it comes to consumer confidence we had on Wednesday last week, and also when it comes to corporate confidence. We're seeing the capex plans from the regional Fed districts are beginning to roll over. So the worry you can have is that the soft data is saying that both consumers and corporates are beginning to worry about the outlook. The issue is in the data today is, of course, that was measured in the 12th of the month, meaning the 12th of February that week, and that was just before things really started to begin to become more intense on the trade war front and also on the Doge front. So from that perspective, the data today at 151,000, it was relatively strong, but it is, of course, very importantly something that now is the rearview mirror compared to some of these risks that we've been talking about in the last few weeks.
You are expecting the data will deteriorate. Just factoring in those things, more layoffs from the federal government, and plus the impact, the ding in consumer confidence.
Because I think Scott Besson is absolutely right when he's saying that there is some detox period or there is some adjustment costs in going from an economy that looks like what it does today to the economy that the administration is trying to achieve, both with a lower level of federal government, but also with changes very fundamentally in how big is the manufacturing sector, what's going on with imports that also have to be lower. And that adjustment period can potentially take some time, and it can potentially be painful. And it could, in the very worst case, also involve the recession, in particular if all the sentiment data begins to be reflected in the hard data in the form of weaker economic numbers.
Torsten, there's been a lot of focus on government jobs. And to Melissa's point, if there's going to be more layoffs, put it in perspective for us, the total government jobs as a percentage of all the jobs, and what would that unemployment rate get to if they canceled all government jobs, which they know they're not going to do, but you have to have the ancillary ones for every government job. There's another person that's hired in the private sector because of that government entity.
Absolutely. So if you look at total employment in the federal government, it's about 3 million people. And if you look then at studies from Brookings and others show that for every federal employee, there are 2 contractors. So that means that if you have 3 million and you add 6 million contractors, you get up to 9 million people, who basically is the true number for what is total federal employment. Total employment in the U.S. is about 160 million. So now you have, in very round numbers, 9 million people out of 160. But if you then also take into account that you live in a household with someone who might be in the private sector, the total number of households is 130 million. And therefore, if you now say that roughly 10% of all households, meaning between 10 and 15 million, are impacted in some way or another, it's not so much the direct effect of layoffs from federal workers. It's really more the sentiment effect that you begin to say, maybe I should not be going on vacation, which the Conference Board indicators have already been suggesting. Maybe I should not be buying that car. Maybe we should not be buying that new iPhone. Maybe we shouldn't be buying that new washer and dryer. So the fear is not so much the direct hit from Doge. Even the direct hit from tariffs could also be somewhat limited. It's more the spreading of the sentiment that people begin to pull back, and in the worst case say, well, maybe we shouldn't be spent so much in the household sector, and maybe corporates also say, well, maybe we shouldn't hire if there's such an elevated level of uncertainty. That could be the real risk where things could really begin to accelerate. That's not the scenario that we think is the baseline. We still think we will not get a recession. We think it will only be a modest negative impact, but we do worry about the sentiment effect, especially if uncertainty persists at this elevated level.